June just closed the books. And if you read the headlines, you might have thought that the S&P was a dud for last month. But there were fireworks going off that no one was noticing. The equal-weighted S&P 500, small caps, mid caps, quality stocks, dividend growth stocks all finished the month higher. And if history tells us anything, the fireworks might just be getting started for the month of July. So stay tuned for the next View from the Ranch July edition. Welcome back to the View from the Ranch, July 2026 edition. My name is Greg Pasitti, and I am here with my Chief Investment Officer, good buddy, and patriot, Brad Tremetary.
Hello, Greg. I'm dressed up this month as good old Uncle Sam without the gray facial hair to celebrate the 250th anniversary of our wonderful country.
Nice.
Yes.
You look great.
Well, it's hard to put on this type of face with these type of costumes and always pull it off.
You do every time, time.
And again, maybe this helps out my face for radio. People look at my costume more.
Yes.
So
good
just
point.
Here to celebrate 4th of July, wishing everybody a happy 4th. Celebrate the country. 250 years is pretty incredible. Doubtful we'll have another 250 years with the amount of debt and division we have, but for now, let's
stay positive, Brad.
I'm talking maybe in 248 years we're gonna have
Yes.
problems, but for the next 248 years, good to go.
Be careful with the fireworks out there, right?
Well, I just stay away. They scare me.
Yeah, good call. Yeah. Stay with your dogs.
Anytime I hear those loud bangs, I get scared and want to run in my basement, but since we live in Florida, we don't have basements.
Good point.
Yeah.
Good point. We'll just hang in the pool.
Yeah.
How about that? All right. So June was kind of a tale of two different markets. Like if the S&P, the NASDAQ was slightly down for the year. Not too bad. Like we were cautiously optimistic, but small caps are up like over 6%. Mid caps, dividend stocks, dividend growth stocks, equal weighted S&P. So what's going on? What are you seeing as far as that divergence that's occurring?
Well, it's kind of like there's a few different areas inside tech that have just been bloodied this month. I look at some of the names like Microsoft and the way it's just relentlessly, and they all started selling down at the beginning of June.
The Mag 7?
Well, not all the Mag 7. Google has held up a little bit better than the others.
It's down quite a bit, though, from the high.
The benefit, what people should focus on, is the fact that while these leaders are pausing, as we've seen for most of the year, the rest of the market's picking up the slack. Okay. And that's really a sign of a rather healthy market. So it's good to see small caps lead. Usually when small caps lead, it leads to better performance overall. Looking at the New York Stock Exchange, NYSE, it's done relatively well this month. The S&P will be down slightly, I think, for the month. But again, anytime we can get an offset when tech is weaker that other areas pick it up, it has to be viewed as a relatively big positive.
And a chart we'll bring up is I saw a chart that showed the equal weighted tech index was up pretty substantial this month, up like almost 40% for the year, where the NASDAQ is still up in the teens. But there's definitely a difference because the NASDAQ is so heavily weighted with the Mag 7, and that the Mag 7 was slightly down for the year. So that's like those big tech companies are been more of a drag on the tech companies, and the reason being is they're the ones spending all the money, right? And so they're spending their capex, they're spending billions of dollars, and then the other smaller companies or the companies on the periphery, they're benefiting from that. They're riding their coattails, and so it seems kind of common sense. So this is why maybe they're not growing as much, because they're doing all the spending and other people are benefiting from that. Would you agree with that?
Well, I still think all their balance sheets are pristine.
Mm-hmm.
The simple fact is that over the last 2 years, was spending's increased, free cash flow's gotten compressed, and it's to the point where it's worrying people on the street. So to offset some of that compression of free cash flow, a lot of these companies have come out and started to issue debt, which Oracle did last year. Meta did last year to a larger extent. now they're going to start secondary stock offerings instead of issuing debt. And a couple weeks ago, Google announced $80 billion in stock offerings, $40 billion this year, $40 billion next year. That's going to be an overhang for a while. Meta's announced it. Oracle's announced it. So they're offsetting that spend in different capacities that, just takes some of the shine off of them for the time being. I think we're probably within a year of this acceleration ending. If you look at Oracle, a couple of years ago, they were spending, I don't know, maybe $10 billion on CapEx. Now they're spending close to $100 billion on CapEx. It's gotten real expensive. But like we say about a lot of things that take off and go parabolic, as fast as they go up, they're going to come down probably just as fast. So eventually this spend is going to work out.
Yeah. They're investing for their future. And so there's a high probability that it works out, and you got to spend the money to grow. And that's what the direction that they're headed in. Now in June, a lot of the sector leaders flipped. Healthcare, which has been kind of a dog this year, led the month with up over like 7.5%. Industrials were next, and even financials were up. Although tech and then communication services and of course energy energy went kind of parabolic itself. A lot of that has come down double digits. Do you think like this is again healthy, that it's broadening? It's just not all tech leading everything?
Anytime we can broaden's good. It just never lasts. We saw earlier this year. Then, when the market had trouble in March and early April, everything just condensed right back down to tech. Now, over the last few weeks, it's widened back out again. So it ebbs and flows. Maybe there's some standouts that come out from other sectors that can help lead. But for the most part, when you look at some of the leaders like in industrials, so many of those names are all tied to data centers, AI infrastructure, anything that has to do with build outs. So it's this trickle down theory from the hyperscalers being Amazon, Google, Salesforce, Microsoft, Oracle, that trickles down to the memory chip makers, regular semiconductors, infrastructure build. So you need that spend to keep the market going. And it's done a very good job, but I still have a hard time believing that a longer term broadening will hold for an extended period.
Yeah. A lot of those stocks have gone like straight up like a hockey stick and are trading at like extreme multiples, and it's just hard to invest when something's up 200%.
And on the other hand, when you look at the big players that have, basically been flat to down this year, that have been the leaders on a fundamental basis, they all are starting to look relatively cheap.
Okay. So maybe you see it as an opportunity to maybe, rotate a little bit more into there
at some point, but I would say for the broadening to continue, we'll have to get into a period of lower interest rates where, interest rates are, working themselves lower. Expectations are for lower interest rates. And then in that case, there's more liquidity that can spread out.
And there's a lot of rebalancing that's done at the end of the quarter. So that's, I'm sure, has some influence on that. And the breadth, though, which you always talk about.
It's been amazing to see kind of the different leaders in the market. But last Friday on June 26th, we got an all-time high in New York Stock Exchange breadth. We got an all-time high in S&P 500 breadth, which isn't as important because it's only 500 stocks. But we hadn't made a new high in since March. Yet the S&P had made a new high. So these highs confirm that market high, and now we're to a point where breadth is moving higher faster than stock prices. We had that last year, and when breadth is leading, it's going to pull everybody else up with them. So we should expect the market, NYSE and the S&P to be able to make new all-time highs.
New highs in breadth.
Yeah. Any weakness that we get should be, shallow, shouldn't last very long, unless there's a black swan out there, but we don't see something. So we should be able to continue to move higher. And it's good to see, breadth, which, positive breadth just means that there's more stocks that are up every single day. And when I look at it from a year-to-date basis, again, we've mentioned this before, where the cumulative breadth is for the New York Stock Exchange relative to, the data we have back to 1960. Anytime we're at these levels, we're almost always positive. There's only been 2 years out of, I don't know if we have it down here, 2 years out of, say, 25, that we've been this strong in breadth, and we haven't had a positive year, and that was 2001 and 2018, which each of those had their own issues.
So 23 out of 25 years, positive breadth, all-time high breadth has led to higher markets.
And the average return in those years is like 20%.
Okay.
For the S&P. So,
and now we're heading into July, your favorite month, obviously, from your patriotic side, but also from a opportunity to make money. Tell us about July and your thoughts on July.
Well, it's been the best month really since the great financial crisis. Even going back longer than that, it's been, I think since 1950, it's averaged like 1.3%.
Okay.
Up 15 of the 17 years since the end of the great financial crisis in 2009. It's been up for 11 years in a row. Its average return over those 11 years is around a little bit more than 3%.
Okay.
It just, for some reason, happens to be now the strongest year. I mean, the strongest month of the year. You can always sit there and say, well, the streak's gone on for too long. But for some reason, when you break it down and look at quarters, it's by far the best the best month in the third quarter. And it's strange because it's always so good. Then August is basically flat historically. And then September's down, which goes back to what we have said the last couple months. It's not sell in May and go away. It's sell in August and come back at the end of September, beginning of October.
It doesn't rhyme very well.
Yeah, I know. There's no rhyming to it.
But it makes you money, so you can have something that rhymes or makes you money.
It just, for some reason, July's been very strong.
But you don't know why that is, or you have any kind of hunch as to why July is strong, or just patterns that people kind of follow?
No, you go back to 2022 when we had, the last midterm year. I mean, 4 years ago, the market was in a pretty dark place right now. But at July, the market was up almost 10%.
Yeah.
So, again, this is a pathway to weakness in September and April. Okay. I mean, August and September. And in whole, the market's been much stronger than what we normally would see in a midterm year. So,
and earnings have been good, right? I mean, what's your take on the earnings so far?
Well, I mean, we've mentioned that last month. I think they're all very strong. What we've seen as far as positive revisions have been historical. It's just a matter of comps are going to start getting tougher. So we have to keep going. Not saying that the beats are going to be as big, not saying that the raises are going to be as big, but that may slow down the speed of the market a bit. Still, it's across the board.
Yeah,
relatively
I'm starting to see a lot more earnings estimates being raised, a little bit more confidence in the economy. I think as we're winding down, supposedly, who knows for sure, the Iran situation. So you've got all-time highs in breadth. You've got history on our side with a strong start for the year. You're coming into July, which is one of the best months of any year. And you've got some fresh liquidity that's coming in the market. Let's talk about that.
Well, we continue with the refunds on the tariffs. I think so far there's been about $36 billion in tariff refunds that have been sent out. That should help 2Q earnings per share by about 3%, maybe a plus 50 basis point add to margins. Mm-hmm. So that should help make this earnings season maybe a little bit better. And there's still more money to come from the tariff side. Not that I agree with it, but that was the rule of the land. So we've got money coming back into these companies, as well as starting July 4th, it kicks off what are called Trump accounts, which are accounts that parents can set up for their children. They're tax advantage accounts that are going to be invested into low-cost index funds. And for children born between 2025 and 2026, the government will start you off with $1,000 in the account. So, we're estimating that there's about $20 billion worth of additional investment dollars coming into the market. And most of that will probably come in July, over the month of July and into August. So,
Okay.
and those are going right into the indexes. Now, 20 billion isn't a whole ton of money when you look at the massive size of the market, but especially when we get into August and September, it's extremely helpful to have another stream of income coming in to the marketplace.
And we'll send a link of how a parent could sign up for that and get that going right away. I mean, you want to do it in July, like start off with one of the best months that you possibly can, and
that's one of the positives. I mean, we could sit there at times and say, hey, we're gonna have liquidity coming out because there's tax days that come up. Sometimes in the state of California, when they've delayed their tax due dates, because of natural disasters, as an example, to say October, we run into a little bit of volatility in October because it's such a massive amount of money that needs to be sold to be paid out for taxes. But right now, there's not too much draining on the market.
Okay.
Which is good.
And we've gotten through the first big IPO of the year with SpaceX. It came out at $135 a share. It popped like 19% the first day, went up well over, I think it was $220 at one point. Kind of went back down to the mid 150s, trading around 170. What was your kind of, when you look back, like, did it play out the way you thought it would?
Kind of as expected.
Yeah.
It didn't crash and burn like Facebook did, which was the last stock that had a big allocation to retail investors. So that's a positive. It'll be interesting to see how it reacts after July 7th when it goes in the NASDAQ 100. It's still not going to go in the S&P for at least a year, so you don't have to worry about that. But the way that they have their lockup set up, it's a certain amount of stock is going to come out after different events, and I think that's a positive because it's going to slowly increase the float that's out there without, hundreds of millions of shares just hitting the market on the IPO lockup. So
when does that lockup?
It's
remember
what is it? December, I think.
Okay. I thought it was shorter. This one.
Well, no, this one's spread out over a number of different variations. The last lockup is 6 months out, but it's some of the shares will lock up after the earnings in August and the earnings again in November. If certain performance numbers are met as far as stock price goes, there's some more shares that end up getting unlocked. So the idea is that there's, maybe
unlocking means that the insiders who were in on it before it came out could start selling their shares.
Yeah,
and they could
the restrictions
sell a lot.
are removed.
The restrictions are.
But instead of 70% of the float or 70% of the stock that's restricted hitting the market all at once, this is kind of slowly letting it out along the way. So
there's a little bit of guardrails there, but
it's really the first time somebody's done this, and so it'll be interesting to see how it works.
Okay.
I think it's going to be a positive. It will keep the stock under control from going crazy or getting destroyed. Mm-hmm. And then after the lockup period ends, it's freewheeling.
Yeah.
So
we've been telling clients just to, if you're interested in it, just nibble into it, put some buy orders in lower than where it's at. If it hits, it moves fast. And so I just think, you kind of dollar cost average into it. They have a long ways to go before they start making money. They're, losing hundreds of millions of years. The idea is brilliant and it's great, but it's a long-term thing. So just be patient with it and don't be that person that buys it at the top and gets, makes an emotional decision because the FOMO, the fear of missing out. But one to drip into, or at least consider doing that. And so we also had our first new Fed chairman, Warsh. Is that how you say it in Pittsburgh? Warsh. Yes. Do you say
Warsh?
Do you say that you wash your
Pittsburgh,
clothes?
it's Warsh. You're gonna wash my clothes.
Is that how you say wash your
yes,
clothes?
But it's Warsh.
Warsh.
In this guy's case. So
okay.
The first Fed meeting was a couple weeks ago, and it was a breath of fresh air. The Fed statement after the meeting was 130 words versus, anywhere from 300 to 500 words that, we were used to receiving over the last 15 years. It was straight to the point. There was no listing each voter and, whether they voted for or against. There was no projection of, basically future expectations. They got rid of the dot plot. Really just keeping it simple and getting the confusion out of the statement. And he did a pretty good job in his conference afterwards too. Just being straightforward. We've since the great financial crisis, we've become used to the Fed being excessively open with dialogue. And honestly, that doesn't help anything out because it gets the market expecting for one thing to happen when, then they turn around and something else completely different happens. You go back to 21, they kept saying, oh, inflation's transitory. It hasn't been transitory. Yeah. So then they're going to overhaul some of the data that they look at and how it's comprised. Obviously, when we talk about like job numbers, there's a lot that needs to be changed with the way they figure out job data. And I'm sure there's a lot they need to change when it comes to inflation. So the idea is that, they're going to tell people what they currently see and basically leave it at that.
So it sounds like you approve so far.
The problem I have with the Fed is there's just, even the Fed Reserve presidents, they're all out there talking all the time. Somebody quoted, I'm trying to think, the lady used to be the head of the Kansas City Fed yesterday about her talking about, raising rates. And, that's great. But you go back 4 or 5 years, she was still talking down inflation and saying we need to do stimulus while inflation was up 9% year over year. So they love to hear themselves talk. So
went there 15 minutes.
Yeah.
On the camera.
They're smart people,
yeah.
But again, it all can be simplified. And I think that's what the new Fed chair, Warsh, is trying to do. Not Warsh.
Now, though, I think the street after the meeting, the tone was a bit hawkish. Mm-hmm. that some of the plots, whether it's the Feds or not, they had them potentially raising rates like one time this year. Whether that happens or not, who knows? But like that seemed like the Treasury market kind of sold off after he spoke. And did you get that same sense, or is that just like someone made that consensus and everybody followed?
Again, like what we talked about, 7-8 months ago, when they should have cut because the rates were too high above the 2-year. Now, kind of the other way, the 2 years high enough above the Fed rate that they could raise it, a quarter point.
So either 2-year rate has to come down, or if they raised a quarter point, you wouldn't think that's
correct.
Too big a deal?
No, it just needs to get in line. It's the easiest thing to do. If we got rid of the Fed and just went with the 2-year, we'd know where we stand every single day, and we'd have less of these boom and bust cycles out there.
And if they raised a little bit, just because if the economy is doing well, and you don't want it to overheat, and
I think the increase, a hike before the end of the year is already priced in.
Yeah.
So when you look at Fed futures, most are expecting Fed prices to come up, or Fed rate to come up at least a quarter point before the end of the year. The question is whether if good news, economic news, then becomes bad news. Because if there's too much of a positive economic period out there, then it's going to pressure asset prices because they're going to fear that the Fed's going to have to keep raising rates.
Yeah, and that's so contradictory. Of the economy is doing great, everything's great, and so the market sells off because they're worried the Fed's going to raise rates.
Again, we're
never
not
really understood that.
We're not going to have massive inflation without crazy oil prices and being basically in the middle of a war, and you could say for excessive economic stimulus, which we're not going to have anytime soon. I'm talking about the economic stimulus like we had after COVID. Mm-hmm. But if we can keep things under control in Iran, that's going to go a long way to moderate inflation relatively quick. Oil's come down significantly. Gas is still floating around. It will come down eventually. That just is a lagging price to the price of oil. If I look at the oil volatility, the oil VIX index, we mentioned it when it took off back in March, how massive of a move higher it went. It's retraced the whole thing. That index now is basically close to its average price for the last 15 years. So we just got to get oil and to go the right way.
I mean, it's down like 19%, I guess, from its
Yeah,
high.
it's not too far off from where we
Yeah.
where we were beforehand. But, there's been damage done, so that takes a while to rehabilitate. And there's still fear out there that these ceasefire agreements aren't going to hold long term. Part of the problem is that you continue to have, there's no leadership in Iran, and you continue to have them doing different things in the Strait of Hormuz when, there's supposed to be an agreement in place. Okay. So they now have some entitlement that they feel about controlling the strait, and that can't be the case.
But there is oil flowing.
Yeah,
now,
much, right? Much more than there was in the past.
Okay.
And you're going to see, as we said, you're going to see other countries start to build out, whether it's different pipelines, ways to get around the straits. But the big key to us is that the UAE is out of OPEC, so they're going to increase production. We can keep increasing production. Hopeful that Venezuela gets out of OPEC and they can, especially with what they went through with this earthquake last week. The country's still in bad shape economically.
Yeah.
And if they can produce, and release all their oil onto the open market, it would be an economic windfall for them.
Okay.
It would help prices come down globally in a massive way too. So
yeah,
that might not be something that's going to happen this summer or the fall, but longer term, breaking that cartel is going to work out positively for basically everybody outside of, a few countries.
Yeah.
So
hopefully helps their country rebuild where they been hurt with that earthquake. Yeah. So
we got a Fed meeting on the 29th, so I don't expect them to raise rates.
Okay.
They may give you a little bit more hawkish comment if the data's strong, but that remains to be seen. We could get CPI and PPI and
is that all coming out in July? What's on the calendar for July?
Oh, everything comes out, but it's usually that second week we get CPI and PPI.
Consumer price index.
Yeah.
It measures inflation, so like the numbers will start coming out. That'll be market movers. People will pay attention to it.
But the thing is, if we start thinking too much about rate increases, then let's just say we have great job numbers in August. The market's going to freak out. Well, the job numbers are so good, we got to start raising rates again. I really think that's what Warsh is trying to get away from, the belief that the Fed is going to always be completely reactionary to every single data point that comes out. And if we can get away from what we've been on the last 15 years or so, I think it's going to be great.
Yeah.
It's going to make the market less volatile.
I've never heard you say anything good about a Fed chairman, so this is
well, it remains to be seen.
Times.
I used to think that
giving him a chance, though. Sounds good.
I used to think that Jerome Powell knew something, but go back to we talked about breadth, and one of those years where breadth didn't work out was 2018, and he misinterpreted the market because he started raising rates ever so slowly, and our economy was in a different position still then. At the same time, he started running off the Fed's balance sheet in a large way, and that sucked liquidity out of the market in a massive way in the second half of 2018, which led to the market, the S&P closing down like 4.5% after being strong for most of the year. So again, they make it so difficult at times. Let's hopefully this guy's going to stay simple and follow the footsteps that he's starting to lay out after the first meeting.
Yeah. So far, so good though. So, all right. One final question. If someone is sitting on cash right now, what do you tell them? Put it to work, wait it out, wait till after September.
July is so good. August, September usually are so weak. And knowing that the midterm year, you generally see weakness into the end of September, beginning of October. I think you don't plow right in with everything, but you can set up a plan where you add some, dollar cost averaging, even though I'm not a big fan of dollar cost averaging like some other people are. Just because of what the calendar looks like in front of us. And we don't want to be nimble that we buy in and we sell out, at the end of July and then buy back in October.
Right. We're not traders like that. Yeah. Some people are.
Yeah. But I just think that being a midterm year, you just do a little dollar cost averaging over the next couple of months. Then once we get to October, things start to even out. And then when we get into the third year of the presidential cycle. It's always the best.
Okay. So a lot of positive things to consider, and a lot of bullish data points.
A lot of great costumes too. Once again,
amazing costume.
I will take recommendations for August.
Oh yeah.
Anybody has any ideas? Make them clean, and
let us know.
Not too embarrassing, but
let us know in the comments.
You want me to dress up like somebody interesting? Just let me know.
I'll have to think about that. I'll have to ask, Chat GPT.
Someday I'm gonna dress up like you, Greg.
Oh well, March, my birthday, my birthday month. So, all right, well that's it for this month's edition of View from the Ranch. Thanks for joining us. If you like it, please subscribe so that we have more than just 5 subscribed. Now we're gaining a little bit. I think people watch it, but hey, we enjoy it, so we like doing it.
It's just the costumes. Yes. They're just here for the costumes.
And if they listen to Brad's advice, I think they would be probably doing a better job as an investor. So you've had some really good calls, buddy. I'm proud of you. And the outfit is just on point as always. So thanks for joining us. We'll see you next month. A View from the Ranch. Thanks for joining. God bless.